there is no Canadian housing market right now. We're seeing very different geographical trends.
Ben, I'm really glad you're here. We have a little bit of a national mess in the real estate market and some interesting things happening in the economy. And we always like to touch base with you before the real estate market starts going here in spring. So I'm glad you're joining us. I want to start by talking a little bit about interest rates. Now, the Bank of Canada has an interesting job ahead of it, but they're looking at mostly the same data that we're looking at. I know for a little while you've been saying that it looks like the market's pricing kind of flat to slightly upward interest rates for 2026, but you had some hesitation. I'm just wondering, is that kind of still your thesis? And what are you seeing right now?
Well, I think, had we had this discussion a week and a half ago, I think I would be more emphatically of the view that, probably interest rates would have to go a bit lower. All the issues impacting inflation with regards to energy prices are going to complicate things. So let's just take a step back and kind of lay out the lay of the land for everybody. It's pretty clear to me that the Canadian economy is not it's not weak by any means, but it is on a decelerating glide path. So we can see this in the GDP numbers. We had a negative Q4 reading. Some of that was related to inventories, so it was a bit of misleadingly weak quarterly reading. But that's now 2 quarters out of the last 3 that we've seen a decline in the Canadian economy. If you know the kind of technical definition of a recession, it's 2 consecutive quarters of declining GDP. So we kind of just skirted a recession in the back half of the year. Consistent with that, we have seen the labor market start to really soften. And in particular, there's 2 main data sources with regards to employment in Canada. One is a household survey where they literally call people and ask them. We get that data pretty regularly. It's very timely data, so it gets a lot of attention, but it's not necessarily the best quality data. You can understand when you're doing a survey, you often get kind of some wacky data. The second is what we call the payroll data, and that actually draws from payroll remittances being made by businesses. So it's much better quality data, but it tends to lag by about 6 weeks. And so by the time that data comes out, people often have forgotten about that you know what I mean? Like by the time we get the December jobs report, it's the middle of February, and people are like, well, that's old news. The reason I raise that is because that payroll data is showing a really serious weakness that's spreading across the private sector, particularly in the back half of the year. And I think that's more consistent with what people are seeing on the ground. And in particular, I mean, you folks out in Manitoba won't see it as badly as we are feeling it here in Ontario and Quebec, where we're sort of the manufacturing center. We have a lot of ties to the U.S., and so we're feeling it here for sure. Now, the reason I lay all that out is because I would have said even 2 weeks ago that given that sort of decelerating trend in the economy, I would still lean towards us needing more rate cuts to put a floor under things. Where things have gotten a lot more complicated is just in the last week, we've seen the price of oil explode higher. Nationally, we're looking at almost $1.60 a liter on average across the country. I don't know what it is where you guys are. We're around $1.40, $1.50 right now here in Ontario. And look, that is a major upwards inflationary pressure that we're seeing. And I think all else equal, my analysis is showing that we're going to add about 0.6 percentage points to CPI for the month of March if these gasoline prices stay here. It's a really significant deal. It makes it really hard for the Bank of Canada to cut interest rates in a slowing economy if you also at the same time have this upward pressure on prices. So it's a real pickle for them. It's a very fluid situation. Who knows what's going to happen with all the tensions in the Middle East? We could be here a week from now and it all this is boiled over. But for the time being, it's a really tricky situation for the bank.
So coming to the end of the year, we had GDP slowing down, so the output of the economy is kind of weakening. You said the one source of employment data showed moderate picture, and the other is showing a real slowdown in the employment situation, and we're getting that information lagged. And there's another source I think you look at sometimes is active applications for EI, and I think that's also trending up. And employment's a bit of a weird a weird story. And couple that, you said you've seen some softness in the Canadian consumer. Softest Canadian consumer since 2009, if we exclude the pandemic. So those two things aren't feeling too good. Now, talking about employment, it's a tricky story, because people who are angry at the job market and decide to leave it, to stop looking for a job, they're not counted as unemployed.
Well, they're discouraged workers. So it's a great point. Actually, you raised two great points, Andrew, if I could comment on them quickly. One is that you're right. You've got these two parallel labor market surveys that normally tell more or less the same story, but right now are telling completely different stories. And a reasonable question might be, well, how can we kind of try to triangulate and use supporting data to give a sense of what's happening? And you make a great point. I think if you look at secondary indicators of the labor market, so things like employment insurance claims, you would expect that if the economy and the labor market is soft, that you would see employment insurance claims rising. And that's exactly what we're seeing. So I tend to think that the data that's showing that the labor market is quite soft is the right data. And you can kind of corroborate that. Now, where it gets really confusing for people is you've got this soft labor market, but at the same time, Stats Canada comes out last month and says, well, actually, the unemployment rate fell. Even though we lost jobs, the unemployment rate fell. And this is where you get into the realm of kind of wonky economic statistics. But one of the strange things in economics is if you are not looking for work, you are no longer unemployed according to the standard definition, which is a strange way to think about it. So if you effectively have been looking for a job for 3, 4, 5, 6 months, however long, and you just throw your hands up in the air and you say, I'm done with this. I'm just going to collect EI, or I'm going to live off of, I'm even going to, I'll just ease into retirement or whatever it might be. You're technically no longer in the pool of the unemployed. And so you had a situation last month where, normally this doesn't move the needle that much in any one month, but last month we had an enormous drop in what we call the labor force, which is the collective group of people who are either working or looking for work. And that drop was primarily related to a big uptick in discouraged workers, people effectively just giving up. So even though the unemployment rate ticked down, it ticked down for the wrong reasons. Right. It's still not a good indicator of the strength of the economy. And I think that, again, corroborates this view that the labor market is softer than some of the headline data suggests.
And if you're an economist trying to figure out, what's this going to mean for consumption in Canada, it's a really tricky thing to parse signal from noise there, because unemployment going down sounds like a good thing, but if it's people leaving the workforce, that might not be a good thing, depending on where they're going. And the population in Canada is another interesting thing. So you said discouraged workers was a big driver of the change in the unemployment rate. I know that we've had a monumental rise in the population in Canada over the last 5 years or so. And now the floodgate seems to be not only turning off, but closing, and a lot of non-permanent residents are leaving. How does that play into the situation?
Yeah, it's a great point. We are in sort of a sea change as it relates to our population growth trajectory in the last couple of years. Coming out of the pandemic, I mean, this is a fairly well understood story now, but we saw enormous population growth, very tight labor market, right? A lot of people didn't want to go back to the workforce. There's a lot of fear about potentially catching COVID. And so there was and at the same time, we had all these stimulus checks being mailed out. So there was a lot of demand, not a lot of people working, right? And so, you had this strange situation where employers were legitimately in need of workers. And so we brought a lot of people in. At the same time, we also sort of allowed, for whatever reason, this kind of, sketchy, this sort of explosion in international students. Some of them very legitimate, but a lot of them kind of go into these kind of quasi-legitimate colleges. And the point, I guess the main point is, when we hit kind of 2023, 2024, that cohort of what we refer to as non-permanent residents was growing by 800,000 in a single year, on top of the 400,000 permanent residents we were adding. So we were growing, in effect, by 1.2 million people in a single year. We've never seen anything like that in Canada. And, with a bit of hindsight, we look back and we go, well, that was probably a bit much. It strained a lot of social services, strained a lot of, the infrastructure that Canadians rely on. And we're trying to course correct. And the way they've decided to course correct is they've effectively slammed the door on that temporary resident cohort. So we're seeing a dramatic drop in international students, a dramatic drop in temporary workers. And that cohort that had been adding 800,000 to the population in a single year is now declining by a couple 100,000. So you can imagine when you take a group that's adding that much to all of a sudden declining that much, it moves the headline number dramatically. That has all sorts of ramifications for the economy, because if you think about it at the most basic level, economic growth is just population growth times productivity. So if your productivity is unchanged, but your population growth slows, the natural trajectory of your economy is that that sort of baseline of growth is also going to slow. And so that's where we find ourselves today. We're in a very different population dynamic. That also has ramifications for the real estate market, although not in the way that most people think. I know we want to get to it, but I will just sort of let the cat out of the bag. It's a much bigger deal for the rental market, and not nearly as big a deal for the resale market, which I suspect we'll get to.
Yeah, I think we'll get there. That's a good foreshadowing. So, decreasing population, maybe a weak unemployment situation, maybe some inflationary forces. We've got these forces that are suggesting we might have some trouble ahead. Why is it more likely now that the government of Canada might raise rates than keep them steady?
Well, I think a lot of that feeds back into this sort of inflationary pulse that's coming out of the energy markets. There were some. The market was telling us that the next move from the Bank of Canada was expected to be a hike later this year. Obviously I disagreed with the market's assessment, but it was telling us that it was going to be a hike, and a lot of the reason was that for in as much as the economy is not booming by any means, it is still holding together better than anyone expected. Right? Like if we think about a year ago, we were facing higher interest rates, a lot of mortgage renewals. There was a lot of expectation that consumers would slow, that housing would be a much bigger drag on consumer spending. And it really hasn't materialized. Like you have to give Canadians credit. Like our consumer has been really rock solid through all of this. And so we got to a point where the market was assessing that maybe the worst was behind us. And oh, by the way, you have the federal government now moving into a much larger deficit, a projected deficit later this year. All else equal, deficit spending is stimulus for the economy. And so the market's assessment was we had kind of navigated through a perilous time, avoided a recession, and now we were going to face some good stimulus that should underpin economic growth. All else equal, that means slightly higher interest rates. That was the market's assessment. I obviously disagreed. Now we're at the point where you also have this confounding factor of much higher energy prices. That will, all else equal, at a minimum, push the Bank of Canada to the sidelines and potentially force their hand to raise rates if, in fact, inflationary pressure starts to percolate through the economy.
One theme that's been emerging in the U.S. economy is of a K-shaped recovery from COVID. Folks who are doing well economically going into COVID are doing fantastic coming out of COVID. And the folks who were struggling going into COVID are doing much worse. I think we see some of those themes playing out a little bit in Canada. And it maybe not to the same extent, because Canada doesn't have quite the rah-rah consumer that the US did. Although it's good to hear that you think that the Canadian consumer has kind of pulled its weight over the last 12 or 18 months. But do you see this K-shaped economy, the theme, playing out anywhere in the real estate market?
Yeah, well, we can say with certainty that we are seeing that here in Canada. You're right in pointing out that it's not as pronounced as it was in the US, partly because we just have a better social safety net. So it's harder, I won't say it's harder to get left behind, but we're a little more cognizant of addressing that lower part of the K. But I will tell you that what's really fascinating is when we look at things like credit card delinquencies, and when we look at the gap between like homeowners and renters, it's a really, really interesting trend where we're seeing a big increase in delinquencies, not just in credit cards, but really across the credit spectrum, autos, unsecured lines of credit. Delinquencies are rising quite sharply for the non-homeowner cohort, which in general, if we're using broad strokes, tends to be lower income than the homeowner cohort. And so we're seeing rising delinquencies there. delinquencies are rising much less for homeowners in those which was not expected given that you had such a run up in mortgage rates. So I do think you can see it in the data that we are seeing this sort of K-shaped dynamic where lower income cohorts are really feeling the impact of the cumulative cost of living increase we've had over the last few years. In terms of how it plays out in the resale market or the housing market broadly, I think it just gets back to this point that I think we need a period of time where rents just lag and incomes hopefully keep rising, and that will go a long way towards sort of providing some of that breathing room for people who are trying to get on the property ladder, lower income Canadians who are trying to save up. I think a lot of those problems get resolved through just a softer rental market and a lot more supply, and all of that's coming. So I think that's a lot of that will get addressed with time.
So if I'm cracking open my my economics textbook, struggling employment situation, inflation coming up, and interest rates maybe going upwards too, sounds like a classic stagflationary environment. Is that kind of the direction you think we're headed, and what would have to change for if I'm right, what would have to change for that situation to kind of reverse?
Well, it does have a whiff of stagflation for sure. For the folks on the call who may have lived through the 70s, you'll recall that period of time. And just to define the term, normally in an economy, if you get very weak growth, it means you have an excess of typically of supply and not enough demand. Well, that's generally negative for prices. In a stagflationary environment, you get the worst of both worlds. You get not a lot of economic growth, but still a increase in inflationary pressure. That's usually the result of a shock in the energy markets. When we saw it in the 70s, it was the oil embargo coming out of the Middle East that caused a lot of shortage of oil and a big spike. We have a whiff of that right now. You can see it. You get the Straits of Hormuz closed, in Iran. You get a lot. We're talking about potentially 20 million barrels of oil per day being taken offline. That's an enormous shock. Very similar dynamics. So you could end up in that sort of stagflationary world. The thing is, it's very early. We're only a week into this conflict. We don't know how this is going to play out. For all we know, tomorrow Trump's going to say mission accomplished and walk everything back. We just don't know. But if you took a snapshot in time, and we're recording this on March 9th, at this moment, yeah, this does look stagflationary, which is not a fun environment for anybody.
No, it's really not. Yeah, I mean, the oil shock is definitely a stagflationary push. I think we've still seen, kind of murmurs of that starting over the last couple of years. And you say 1970s, it was an energy shock, but really it can come from supply side shocks in a lot of cases. And I think we're seeing that even. You mentioned the effect on trafficking oil, but fertilizer and consumer goods, a lot of this stuff being affected. Continued sustained supply side shocks can give rise to this environment, and really that's what COVID ended up being, was a big supply side shock, and we're still seeing the ripples of that. So definitely doesn't help that we're seeing this oil shock. Doesn't help the story. So okay, rates going up becoming a little bit more probable, but at the same time, stepping into the real estate market, we've got you've been talking for a while about a mountain of mortgage renewals coming our way. And I think a lot of them are touching the ground in 2026. I think you had a chart that kind of showed the average increase a person might expect when they're renewing in 2026, kind of based on when they might have gotten their original tenure. Average of an 8% increase in your mortgage payment, but maybe a quarter of the people expecting to see a pretty significant increase in their mortgage payment. Why would the government want to increase rates on seeing all of these mortgage renewals coming? How does the situation on the real estate side kind of play into the government of Canada's, or the Bank of Canada's decision?
Well, they're certainly aware of it. And I think you framed the issue really well. It was always the case. There was a lot of consternation around this mortgage renewal cycle. We know that a lot of loans, the most loans on record, were originated in 2021. And that coincided with the dead lows in interest rates, an all-time low, never seen it before. That was 2021 or into early 2022. You roll that forward 5 years, it was always going to be that 2026 would be the year where if there was an issue with those renewals, that's when it would happen. So you're right. This is the year where if there's going to be stress, it's going to come out from the consumers. In terms of what the Bank Canada is concerned about, like, it's really important that folks on the call understand the Bank Canada really has a sole mandate to keep inflation between 1% and 3%, so within their target band. It's different from the US Federal Reserve. The US Fed actually has a dual mandate, so they have to consider both inflation and employment. We actually don't have that, at least not technically in Canada. So the Bank of Canada would say that their primary mandate is not to worry about the strain on any particular individual, but to maintain the inflation level in aggregate in between that 1% and 3% band, and that they're very committed to doing that. So, the short answer is, if it came to a scenario where inflation really started to tick up and became problematic, they would be forced to raise rate according to their mandate, regardless of how it might impact a hopefully small cohort of borrowers.
And so that's a good step into the real estate market right now, which is an interesting story in Canada and a pretty diverse story across Canada, as it normally is. I think one of the biggest stories going on right now is that we see a boom in construction of rentals across Canada. And at the same time, like we just discussed, we're seeing a pretty staggering decrease in the population. Talk about a little bit about why we have so many rentals being built right now across Canada.
So you framed the issue perfectly. I think people maybe underestimate just how big this rental boom is. It's quite unprecedented. We've never had this much rental construction happening. As of the fourth quarter of last year, it was about 195,000 rental units under construction across the country. That number is meaningless in and of itself, but when you put it in the context of all of the existing rental units that are in existence in Canada, that represents a growth in supply of roughly 8%. So you're going to see an 8% expansion in rental supply nationally into an environment where, we just discussed the temporary resident cohort is actually declining. Now, a really important point for folks on the call is, if you think about that temporary resident cohort, right? We're talking about international workers, we're talking about foreign students, and we're talking about asylum seekers. They're all renters, all of them. And so when we go back to that discussion previously, where we said that at peak we were adding 800,000 in a single year, that's 800,000 renters that we were adding in 2023, 2023. So you can understand we went through a period there where our rental market was just unbelievably tight. Partly in response to that, although it had been happening for a couple of years prior, but the government introduced a lot of lending programs to incentivize the construction of purpose-built rentals. Very generous funding from the government backed through an entity called CMHC. And I'll just say, as a housing observer, I often criticize the government for having a bunch of really crazy kind of cockamamie plans that they float out that never really work. This program was the opposite. It worked so well. It was the first government program that actually delivered ample supply to the market. And if anything, I would say that we're on the other side of this, and we're realizing maybe it worked too well, that we're going to go through a couple of years where the rental market is a bit soft. So that was sort of the setup. You went through this incredibly tight rental market, enormous response on the part of private industry, partially backed by government loans. And here we are. We're going to face a monster expansion in rental supply. Now, it's not evenly distributed across the country. When I look at the level of construction activity in places like Atlantic Canada and BC, you're talking about, a 15% expansion in supply. That's an enormous amount of supply coming to those markets.
So that's take all of the rental units in the province right now, and they're adding 15% more are being constructed right now.
Yep, in the pipeline, coming to market, which is, into an environment of maybe flat, maybe 1-2% demand growth. So you can see, like, the supply is going to be 15%, the demand is going to be, 1, 2, maybe 3%. That delta, that difference is a direct feed through to the vacancy rate. So you can see just how weak those rental markets are going to be for the next couple of years. It's not as pervasive in say, Manitoba, although you guys have a record amount of rental supply in the pipeline, but it's just not the same scale as some of the other parts of the country. So you will go through a period of time where your rental market is soft. The one thing I keep telling folks is, and when I say folks, I mean people in the real estate industry, you need an adjustment in the rental market, because when I look at rents paid as a share of total consumer spending, we were at all-time highs, unprecedented highs. And what that tells us is that, for renters, they were having to allocate the largest share of their income to rents on record. Well, what does that do? That keeps them from saving a down payment, right? So we know that the home ownership rate for the under 40 cohort has fallen a lot in the last 10 years. A lot of that is overcoming that hurdle to get that down payment. This will help that, right? The second thing I think is very important is, we often lament that we don't have a strong business culture in Canada. We're not creating a lot of new businesses. I personally feel that one of the impediments to that process is that it's really hard for young people to save the capital to go out and invest and start new business, because the rents are just so darn high. So I actually think it's an extremely healthy thing if we go through a period of time for the next 2, 3, 4 years where rents grow much less than incomes, and we allow that next generation to save those down payments, to invest in new businesses. I think it's good for the long term. But if you happen to be a landlord holding these properties for the next couple of years, you're going to want to really hold on to your tenants, because it's not going to be a fun time to be out there trying to fill those units if you have to.
And really, one of the takeaways is that there's a strong interaction between the rental market and the single family home market. They're not mutually exclusive by any means. People try to save up renting so that they can buy a home, and how easy it is to save up affects their demand for properties. So do the prices, and the builders of these properties too are facing the same sort of pressures. So my takeaway right now is that compared to houses, and even compared to condos right now, the construction of rentals in Canada is taking off probably a little quicker than what our population can sustain, especially if we've got maybe a weakening employment situation or a decrease in population. And you touched a little bit on Manitoba there. So BC and Alberta sitting around 15% of rental stock being constructed right now. So increasing 15%.
Yeah, a little less in Alberta. It was 15 in Atlantic Canada and BC. I think it's off the top of my head 11 or 12% in Alberta, which is still an enormous number. Manitoba's less than that. I think it's 5-6% off the top of my head.
Yeah,
you might have it in front of you there.
I got your number. It's 6%, which is which is still a pretty solid increase. I mean, you need the population of renters to grow by 6% in the year.
Just to frame it though, Andrew, if I could jump in. So just to put in context, so if you've got a 6% expansion of supply and assume Manitoba's demand, the population growth over the next couple of years might be cumulatively 1 or 2%. So you're looking at something like a 3-4% increase in the vacancy rate, all else equal. That's not catastrophic. That's going from an exceptionally tight market currently to something that's a little more normal, or maybe on the soft side of normal. I'm not concerned about that. I would be very concerned about some of the places in Atlantic Canada or British Columbia where you could see the vacancy rates go to double digits, which we really have not seen since the 1990s. A very different dynamic. And again, that gets back to a point you raised earlier, which is just that there is no Canadian housing market right now. We're seeing very different geographical trends as we look across the country.
Yeah, definitely. And I want to zoom into to Manitoba a little bit. We're seeing some trouble out in Toronto and BC, especially out in BC. We're seeing prices drop, and not financial advice, but looking closer to a buying opportunity than a selling opportunity. And then Manitoba kind of sticks out along with Quebec in your kind of your rubric as a quad one bull. Things aren't quite looking as bad here in Manitoba, or at least that's what the data's saying. And I've got
so not looking bad at all, Andrew. I think it looks good.
And looking at some stats, I mean, we're doing better than average in Canada on unemployment rate. Population is growing. And looking at the real estate market, it's getting to be an interesting story, because home sales still aren't still aren't necessarily keeping up. Housing prices are increasing, and so it kind of looks like a market that's trading based on supply, and supply still seems to be a little bit tight, especially for homes in Winnipeg. Now that's switching from homes from rentals to homes. Is that kind of what the data is playing out?
Yeah, that's exactly right. And this is where, my view on the rental market versus the resale or broader housing market is very, very different right now. I have very different, and normally they sort of track each other through time, right? A tight rental market will often lead to a tight resale market. Right now, they're going to go in very different directions, I think, over the next year and a half or so. What's still surprising about the Manitoba metros that I look at is that resale inventory is just way below average still, right? We're 4 years into an interest rate hiking cycle, and there's just no supply, which is pretty surprising. Demand is okay, is solid. It's not booming like it was in 2021 coming out of the pandemic, but it's good. And so when you combine like a good level of demand with not a lot of resale supply, you get a very tight market. And Manitoba still sitting at an incredibly low, what we call months of inventory, which is just a reflection of supply and demand. Very tight market. And it's one of only a handful, when I look at like Winnipeg specifically, it's one of only a handful of metros in the country that is still today at record high prices. Now, yeah, that's a good news or a bad news scenario, depending on whether you're a renter or an owner. If you're a renter, you maybe don't love that. Although I will tell you, one of the reasons why it continues to do well is it is still relatively affordable compared to the rest of the country, and we are still seeing inflows into Manitoba from other more expensive parts of the country. So there's that. If you're a homeowner, obviously maybe you're happy with these gains, but I got to be honest, I don't see what's going to stop this market in the near term because there's just so little supply on the resale market currently. And when I look at what's in the construction pipeline, there's just not a lot of homeowner units being built. Lots of rentals being built, not a lot of homeowner units being built. And so the question would be, well, what's going to bring that new supply to market to help, loosen this resale market? I don't see it. So I think this is a market that still has some runway to see continued price appreciation. Maybe not the kind of 7, 8, 9, 10% we've been used to over the last couple of years, but maybe, 4 or 5%. That's still a very robust market in the context of what we're facing in most of the country.
Yeah, like you said, good news on one side of the coin, but not so good news on the other side of the coin. If you're looking to get into the market, rent is still fairly expensive, and it sounds like the home market in Winnipeg still has some legs to run, and not really seeing the softness that we're seeing elsewhere, which isn't totally surprising. Manitoba's always, it goes with the flow, but not quite as quickly. And so we didn't have the boom in the market that Toronto and Vancouver did over the last couple of years, and so we're not quite swinging back the other way and seeming to keep our ground a little bit. And then the other side of the coin, folks who might be looking to downsize right now, folks who are in a big house, and lots of financial planning centers around future projections, including what is going to happen to your house, and in your 40s and 50s, I got to say the mentality is typically, I'm always going to keep my house. My house is going to be there forever. I want to set up a financial plan so that I never have to sell my house to fund my retirement. And we find as people get closer to or further into retirement and having to keep up their home, lots of them are deciding between one of two paths. It's either aging in place and trying to do some renovations to your home so that you can live there for longer, and getting help with the things that you need help with around the house, and ultimately looking for home care inside of your house. And the other path is people who say, I just don't want to deal with the maintenance of the house, whether it's me doing it or me organizing somebody to do it. It's just a bit too much. I want to downsize. And for a lot of people, that means moving into just swinging the needle in the total opposite direction, and moving to something that is as simple as possible, turnkey rental, don't have to deal with anything, can close up and walk away, go on vacation, and don't have to deal with any kind of the maintenance. So let's just think about that person in Winnipeg for a second. They're sitting on a house where the pressures are suggesting it's going to keep appreciating for a little bit, or at least not see as much weakness as we've seen elsewhere in Canada. And at the same time, we're seeing a national trend towards building purpose-built rentals. And maybe it's not playing out quite the same extent in Winnipeg as it is elsewhere, but we are seeing 6% is still not a lot of is still quite a bit of progress. Like you said, it might change a really tight real estate rental market into a bit of a looser one. Are these folks looking at just like a historic gap trade opening up for them, where the thing they're selling everybody wants, and the thing that they want is in super high demand? I suspect the picture's a little bit dirtier than that, but is that kind of what we're looking at?
I like that framing. I'd never thought about it in those terms, but yeah, I think you're probably right. You've got this window here where the time to downsize and to pick up a rental that is not, where the rents aren't going to just accelerate dramatically over the next few years, right? I think is great. I think you're going to be in a, if you were to downsize today, rent, I can see a scenario where what you're paying today in rents is going to be flat, maybe even trend lower over the next 4 or 5 years because of how much supply is coming. Very interesting. The other thing, I guess the other consideration in all of this is for the folks considering doing this trade, we do know that they're not alone. There's a lot of Canadians as folks age and as we get that cohort sort of move into their later retirement years that will be doing the same thing. So I do think that from that perspective as well, you may have a window here where, if you're contemplating doing that in the next few years anyways, it's probably a pretty good time to look to do it. Now, again, does not give financial advice, just spitballing the macro data. I could see a scenario where that could make a lot of sense.
Yeah, it is kind of interesting. And like you said, there are a lot of people trying to do the same thing. And it's weird that we see rentals under construction trending up for a long enough time for us to have seen some of those rentals actually come out, right? So the market for rentals, we should start to see some of that softening depending on how the population picture looks. But at the same time, the folks that we talk to are kind of struggling to find that exact right place that they desire, and it's luxury rentals, mostly I'd say like first floor. And if the folks building rentals are building run of the mill high rise, it might mean that what looks on paper like an awesome opportunity, when you get down to it, there just really isn't that many of those specific kinds of units that the people are looking at. So I think maybe the story is about the same, like rentals coming online and overall downward pressure on rent is a good thing for the savers and for the people who are downsizing alike. But that, you got to pick your opportunity, because this market might end up being a really tight corner of an otherwise pretty loose real estate or rental market in the next little bit.
Yeah, I think that's a great point. And to be transparent, I don't have the real granular data on like the suite mix of what's under construction. So it's hard to know how much of that is sort of tailored to sort of the adult community versus like your smaller sort of entry level rentals. It's a great question. But I have to think, given how much is under construction, I think there'll be a lot to choose from out there in the next couple of years if you wanted to go that route.
So we'll have to see how that plays out, whether the rental market does actually provide all of the opportunities that the downsizers are looking for, or if the rental builders are really just misreading the market and they see cheap money and dive after building rental units in their great big apartment blocks that the folks who are the non-permanent residents would have occupied. But now, we're seeing a bit of an outflow. So it'll be interesting to see how it plays out. And you're right, getting down to the specific types of units and stuff like that. That's stuff that doesn't really always show up in the data. You kind of got to have boots on the ground and have a good real estate agent. But it kind of turns the story to the question for the builders.
When you look at the single family segment, right? Before builders can start construction on a single family home, they have to get a permit from the municipality. So permits are a leading indicator of where housing starts are going to go for the single family segment. And permitting activity nationally is as low as it's been since the 1980s. So you can see where that's going. And so really the only thing that's holding up the entire construction industry right now is this rental construction boom, which I would argue is long in the tooth for a couple of reasons. One is the underlying fundamentals are deteriorating, But secondarily, some of those government programs that were very instrumental in incentivizing construction have been rolled back or tightened. So the writing, unfortunately, is on the wall for the construction industry in 2026 and probably into 27. And that's not a small issue for the labor market because we're still talking almost like almost 8% of all jobs are in construction. Not all of that's residential, but enough that it's going to move the needle this year. So that is one of those things I'm really watching. I do expect that construction is going to really slow. Look, everything's cyclical, right? And we know that we went through a period where we were building quite a bit because population was high. We're on the other side of that. We're still building a lot, even though population is low. It'll naturally correct down with time.
And so that's for purpose-built rental construction. Looking at homeowner construction of single-family homes in Winnipeg, it looks like supply is tight. The lead time from idea to the house being built is I'm guessing a little shorter than for an apartment building. Story might be a little different then for somebody engaged in home building in Manitoba. Is that fair to say?
Well, I still think that from what I'm seeing, again, Manitoba's a little different. So because of the strength of the resale market there, you could see builders actually should be building more single family, and they're not. And that's a very different scenario than most of the other parts of the country where we have a lot of inventory on the market. So it's funny, you have this weird situation where at a national level, I would say 2026 we'll almost certainly see a slowdown in construction activity. In Winnipeg specifically, I think that's true of the rental market because you do have more rentals than you're going to need for the next couple of years. If you are in the construction industry and you are tailored more towards entry-level single family, or as you said, something that appeals to those downsizers, I think there's a plenty of runway for you to be busy for the next few years. We probably should be building more of those. So I would say Winnipeg's a little different. If we take the national snapshot, construction activity will be down. Winnipeg, in particular, the single family segment should hopefully be higher this year to bring some of that new supply to market. So, very different dynamics there.
Yeah, and more incentive on the single family side for sure. Looking at the market, the other topic we get into once in a while is cottage ownership and cabin ownership. And I know we don't have the mountains and we don't have the great big lake like Ontario does, but cottage country in Manitoba is epic and well known and well traveled. Although we do have a bit of a different market than those places. We haven't seen nearly the same level of foreign investment and rental ownership as they have elsewhere. In Manitoba, it's a bit of a weird mix of freehold properties and leasehold properties. A lot of them are on provincial parks, so that complicates the borrowing story and also complicates the supply story. And we're definitely not seeing a lot of new constructions happening. And so supply is sort of capped by the desire to build further into our wilderness. And so we had a pretty major boom in cottage country in the COVID years as people were flocking out of the city. And but it's not totally clear if those were secondary properties or primary properties. And I think what we're seeing is compared to other places in the world, it's a lot more intergenerational ownership. It's a lot of older folks who own their cabin who are just waiting to pass it down to the next generation, and people waiting to get into the market are having a bit of a hard time. So, just to start off, how does the cottage market, whether it's Ontario, Alberta, BC, or Manitoba, usually compared to the general real estate market?
Sure. I'll be transparent. I don't have great granular data on that segment specifically in kind of the Winnipeg area, but if we take a step back, the one thing we know about recreational properties generally is that they are what we would call hyper cyclical, right? If you think about it, you never have to own a cottage, but people have to live somewhere. So in general, what we see is when the cycles turn, usually it shows up first in the recreational properties, right? So if the economy starts to weaken, if housing starts to wobble, if interest rates go up, the first thing people do is they put their cottage buying on hold. And if they get really stressed, that's the first thing they sell. They'll sell their cottage before they sell their principal residence. So because of that, it does tend to have these exaggerated cycles. So, because the overall market is still very solid in really across all of Manitoba, like I would expect that the cottage market is still holding firm. Um, I would watch there for signs of any potential weakness. It will show up there first when the cycle turns. Unfortunately, like I said, I don't have real good granular data on that. That's where you would really have to lean on the expertise of a local realtor. But once that market slows, if it were to slow, I would say that would be the leading indicator that maybe the rest of the real estate market in the big cities would start to slow as well. That's generally the cycle that we find. And then conversely, on the other side, what we find here in Ontario is the cottage country is the last thing to recover, right? So it booms hardest in the good years, it falls first, and it recovers last. But man, that in between period, it really rips, right? So that's sort of the story of recreational properties, hyper cyclical, good leading indicators for the broader market.
I got to think the cottage market in Manitoba is going to be pretty tight again this year. There wasn't a lot of supply last year. I was going to lean on my buddy Dave Ellie from Falcon Realty. He's been selling cottages in the White Shell for probably 30 years. So he's usually my boots on the ground, but he's on vacation at the moment. We'll see if we can.
Yeah, I would say, Andrew, guys like that are who you have to lean on, because it's so hard as an outside observer to really, because that's such a niche market. You really need boots on the ground expertise to really give you a sense of what's happening.
Yeah, believe me, I tried to get at some of the data by scraping some websites here or there, but it's actually really tough because lots of the sales don't run through the MLS. Lots of the leasehold stuff is just really, really tough to track. You can maybe see volumes, but you don't get a really good sense of prices and stuff like that. So tough to find out, but we can guess. We see at the national level a bit of a struggle happening. The consumer is more broke now than they were a couple of years ago. We do actually see defaults rising in Manitoba as well as across the country. And so that kind of suggests that we're closer to the bottom side of this hyper cyclical environment. Thinking that there might be more forces for people to sell in the coming years, but at the same time, Manitoba has this little shield around it, and we are going strong. So my guess is that we're still going to have a pretty strong real estate market, but I think that's really the debate of how does the macro environment kind of collide with Manitoba's shield.
Yeah, I would say, Andrew, I would agree with that. I think if you took a high level view, there's not a lot to be real concerned about in Manitoba right now. Very different lay of the land than a lot of other parts of the country. I think you're bang on.
For somebody who eventually wants to own a cabin, that's not the greatest news, but I have some patience, so I'll sit on my hands for a little bit. Okay, couple stories from elsewhere in Canada. We always want to talk a little bit about what's happening far out west in Victoria, and I don't think we have to get down into the nitty gritty of it, but I think there's an interesting story happening there in BC. Can you give me just a concise overview of what's going on in the BC market? Because I know it's a lot different than what's happening in Manitoba.
Yeah, absolutely. So very quickly, I would say what we're seeing in BC is unfortunately a deteriorating market. What I see is, we just had, I'll use Vancouver as an example because we get their data a little earlier than we get Victoria's. But we just had the two largest monthly declines in pricing that we've had since 2022. So that's after adjusting for normal seasonality. So I would say that market's actually deteriorating, and that's true in Vancouver. It's true from what I see in Victoria. And look, I don't want to you venture into the realms of politics, but what I would say is for the folks out there that are watching the real estate market, what I worry is that we may have thrown a chill over this market given some of the uncertainty around some of the land claims. And I don't know how far you want to chase this, but it is very important as it relates to the real estate market. We've had a couple of very landmark decisions out of BC that have effectively granted what they've termed coexisting title, Aboriginal groups and traditional fee simple title, which is your standard ownership structure. If you're a lender, like, what does that even mean if you have coexisting title? Like, it's a very real question. So it's like one of these things where the courts have thrown something out that's chaos, and we're sort of waiting to see what this all means and how it settles, when the appeals ultimately come down. But what I can tell you with certainty is that the lenders out there are very much taking a wait and see approach, because you can't lend on something where you don't know who owns the collateral. And so consequently, I think that is partially contributing to a softening. It's taking what would have been a softening market, and I think it's accelerating things to the downside, unfortunately. And until we get some clarity around that, it's hard to see how that will change in the near term. So, we've taken a dramatic turn here, going from talking about the Winnipeg's market being pretty robust and all kind of all lights flashing green, to markets out in Victoria and Vancouver that look very much the opposite, and I would say look like they're on a deteriorating trend.
So if you had plans to move out west, now is looking like maybe an opportune time. Of course, never buying or selling advice, but yeah, tale of two worlds, one that's running.
Well, if you can get conviction on what the government's ultimately going to do and how the courts are going to rule, absolutely. Barring that, I think most people are going to be more inclined to take a wait and see. So you're right; it may be an environment that's good for the risk takers, for sure.
And so you're saying that lenders are pausing on, and this is lenders for purchases of residential property.
Yeah.
All the way down.
So in particular, so to get in a little bit into the weeds, so there was a key decision called the Cowichan decision, which affected, it was a relatively small group. You're only talking about 150 homeowners in one part of, I believe it was Surrey. Could have my geography wrong there, but it was a relatively small part, somewhere in the Lower Mainland, and effectively, because there was a recognition of, literally the wording in the court ruling was coexisting coexisting claims on title. For a lender, that's a no-go. You just can't, what does that mean? We've never seen anything like that. And so it has absolutely thrown that particular area into, some somewhat turmoil, but we also just had a major decision or an agreement that was reached just last week with a different Aboriginal group with regards to claims of much of the Vancouver metro region. And so I'm just telling you, the trajectory that we're going on with regards to these claims, it's just creating a lot of uncertainty for lenders, and I believe consequently some uncertainty for buyers who are maybe taking a wait and see approach. So none of it's good, unfortunately, for the resale market out in Vancouver, or Victoria, which was really not booming to begin with. So it's kind of taken a weak market and thrown a bucket of cold water on it.
Yeah, I can imagine the market really doesn't like uncertainty. Maybe one other story, quick, from the other side of the nation, looking out in Atlantic Canada, and you were saying that the rental market looks a little more dire there than in most places. What's caused it out on the East Coast? Is there any other fuel being added to the fire other than just cheap money for single or for purpose-built rentals?
Yeah, it's a great question. And I want to be clear, it's not that the market today is particularly weak out there, but you have just a tidal wave of supply coming. So I think it'll be a very different looking market a year or two from now. In terms of what caused it, so coming out of the pandemic, we had an enormous influx of people, particularly out of Ontario, move out east, right? That whole, out of the city, work from home boom, it benefited the Atlantic provinces enormously. They also, surprisingly, were disproportionate magnets for these temporary workers and international students, which you don't think of Atlantic Canada as being a hub, like a booming, but it very much was. And so they sort of benefited from a huge influx of home buyers and renters coming out of Ontario, and a lot of temporary residents. All of that's now reversed. And in fact, they actually saw collectively their population decline last quarter, which is really not what you want to see when you've got 15% of your rental stock still coming down the pipeline in the next couple of years. So I do worry that maybe worry is not the right word, because again, it's all depending on your framing and where you sit in the market. But I would say that, it's going to be a very different looking rental market 2 years from now than it is today. I would say with certainty that's going to be the case.
Well, thank you so much, Ben, for joining me. We always pick this time of year because we're coming out of hibernation here in Winnipeg and ready to go out and spend some money on houses and look at new apartments. So really appreciate you taking the time to be with us and to share your charts and to share all of your wisdom. Thank you so much for joining me.
My pleasure. Good to see you again.